Hello, knowledge seekers. In this episode of 20-Minute Books, we delve into the insights of Benjamin Graham's classic, The Intelligent Investor. As one of the most respected voices in the investment world, Graham manages to simplify the complexities of financial markets in an approachable and practical way. He navigated through the turmoil of the stock market crash of 1929, learning valuable lessons which he generously shares in his book. In The Intelligent Investor, Graham teaches you how to strategize your investment journey, evaluate companies for stability and profitability, and make sound financial decisions without being swayed by emotions. He advocates for value investing, a disciplined approach that aims at minimizing the chances of loss and maximizing the opportunities for profit. Whether you are just starting your investment journey or looking to improve your current financial performance, The Intelligent Investor offers valuable insights into handling investments like an emotionally resilient business mogul. This episode of 20-Minute Books provides a distilled version of Graham's wisdom, serving as a stepping stone into the world of smart, calculated, and ultimately successful investing. Grab your notebooks as we summarize and analyze Benjamin Graham's timeless financial wisdom in The Intelligent Investor. Tune in, and let's get smarter together. The Intelligent Investor, the definitive book on value investing. Introduction. Unlock your potential. Learn the art of smart investing, like Warren Buffett. The stock market, an alluring game of risk and reward that keeps many of us on the brink of participation. Fear of financial meltdowns, popped bubbles, and economic catastrophes often dissuades us from diving in. But what if there's a safer way to plunge into this exciting yet nerve-wracking world? Here's where the concept of intelligent investing comes into play. Introduced by Benjamin Graham in the late 1940s, this prudent approach to stocks focuses on long-term gains and reducing risk. And the best part? It's a proven path to profit. Over the years, the Intelligent Investor has guided countless people to financial success, with Warren Buffett topping the list of Graham's most successful disciples. Drawing from Graham's timeless wisdom and supplemented with insights from journalist Jason Zweig, this narrative will equip you with the tools to transform into a smart investor. As we delve deeper, you'll unravel the art of tuning out Mr. Market's ever-fluctuating moods, the benefit of beginning your investment journey with imaginary money, and how the most precious stocks may actually be the least expensive ones. Part 1. Invest wisely. Consider a company's long-term value before taking the plunge. Investing, it's a game that can make or break fortunes. Financial history is brimming with tales of individuals like Warren Buffett, who amassed a tremendous fortune by placing their bets on the right companies. Yet, for every tale of prosperity, there are countless stories of downfall where investments went awry. Does this make you wonder if investing is worth the risk? The answer is a resounding yes, provided you harness the power of intelligent investing. Intelligent investors rely on meticulous analysis to yield steady and safe returns, a sharp contrast to speculating, where investors aim for short-term profits, riding the volatile wave of market fluctuations. The inherent risk of speculating is due to its unpredictable nature. It's akin to gazing into a crystal ball. For instance, a speculator might hear whispers about Apple launching a groundbreaking product and decide to buy Apple shares in bulk. If Lady Luck is on her side and the rumors come true, she could reap substantial profits. However, if the rumors turn out to be baseless, she's likely to face significant losses. On the other hand, intelligent investors hinge their decisions on pricing. They purchase shares only when the price dips below the intrinsic value, the value connected to a company's growth potential. As a savvy investor, you would only buy a share if you see a probable margin between the price you pay and the potential earnings from the company's growth. This margin of safety is akin to shopping sensibly. An expensive dress only makes sense if you plan to wear it for a significant period. If the quality doesn't match the price, you'd probably opt for a cheaper option that promises the same durability. The journey of an intelligent investor may not be thrilling, but the end goal isn't excitement, it's profit. Part 2. 3 Guiding Principles to Navigate the World of Intelligent Investing. Intelligent investing isn't rocket science, but it does follow 3 vital principles. Firstly, smart investors consider the long-term growth and business practices of potential investment companies before purchasing any shares. Remember, a stock's long-term value isn't plucked from thin air, it's directly connected to the company's performance. So, make sure to evaluate factors like the company's financial structure, management quality, and history of dividend payouts, the dispersion of profits among investors. Avoid the pitfall of focusing only on immediate earnings. Instead, take a step back and review the company's financial track record. This investigative approach helps gauge a company's performance beyond its current market value. For example, a company might be out of favor now, causing a drop in share prices. But if it displays a consistent profit history, it may be undervalued and thus a wise investment. The second principle encourages investors to shield themselves from significant losses by diversifying their portfolio. Never stake all your finances on a single stock, no matter how attractive it might seem. Imagine the nightmare of investing everything in a promising company, only to see it tangled in a tax fraud scandal. Your investment would nosedive, and all that time and money would vanish instantly. By spreading your investments, you reduce the risk of losing everything at one stroke. Lastly, intelligent investors recognize that their goal isn't to rake in astronomical profits, but to secure safe and consistent returns. The aim for the astute investor is to meet personal financial needs, not to outshine Wall Street's professional stockbrokers. Trying to outsmart those who trade for a living is a futile endeavor. And remember, chasing quick cash often breeds greed and recklessness. Part 3. Understanding Stock Market History, a key tool for the intelligent investor. Before dipping your toes in the investment pool, don't just dive into a stock's history. Instead, make your initial splash into the historical data of the stock market itself. A retrospective glance reveals the inherent ebb and flow that characterize the stock market. These unpredictable fluctuations underscore the necessity for investors to brace themselves, both financially and emotionally. Economic downturns, like the infamous Wall Street crash of 1929, are unfortunately a recurring part of financial history. Therefore, ensure your survival in such situations by maintaining a diversified stock portfolio, thus spreading the risk so that a single financial tsunami doesn't wipe out all your investments. Moreover, be psychologically armored against crises. Resist the temptation to offload everything at the slightest hint of trouble. Remember, no matter how colossal the crash, the market always bounces back. While you can't foresee every upheaval, studying market history can provide valuable insights into its stability. Once you've evaluated market stability, shift your focus to the history of the company you're considering investing in. Examine the relationship between the stock price, the company's earnings, and dividend payouts over the past decade. Also, factor in the inflation rate, the general rise in prices, to gauge your real earnings. For instance, if you anticipate a 7% return on investment in a year, but inflation stands at 4%, your actual return dwindles down to a mere 3%. Carefully ponder if it's worth your effort and investment for such a meager return. With investing, a keen understanding of history is an invaluable asset, so be sure to keep it honed and ready at your disposal. Part 4. Resisting the allure of the crowd and the market's whims. To comprehend the erratic nature of the market, imagine it as a person. Let's call him Mr. Market. Mr. Market is capricious, wildly temperamental, and not the sharpest tool in the shed. Mr. Market is easily swayed, leading to drastic mood swings. This fickleness is mirrored in the market's tendency to fluctuate between unreasonable optimism and undue pessimism. Consider the launch of a new iPhone. The crowd is swept up in the frenzy, and Mr. Market is no exception. This excitement is reflected in the stock market, with rising prices and a willingness to overpay. As a result, unchecked market optimism can inflate stock prices beyond reason. Conversely, excessive market pessimism can trigger unwarranted sell-offs. The intelligent investor needs to maintain a sense of realism, resisting the temptation to follow the crowd or be swayed by Mr. Market's mood swings. Moreover, a cheerful Mr. Market can paint a rosy picture of future profits that might not materialize. Just because a stock is profitable now doesn't guarantee its perpetual profitability. In fact, high-performing stocks are more prone to lose value in the future because demand often pumps up the price to unsustainable levels. Despite this, it's incredibly tempting to be seduced by short-term gains. Humans are hardwired to recognize patterns, particularly those hinting at potential rewards. We're so adept at pattern recognition that we often see patterns where none exist. Similarly, seeing profits surge can trick us into believing in a non-existent pattern, convinced that this upward trend will continue indefinitely. By now, you should grasp the fundamental principles of intelligent investing. In the sections that follow, we'll delve into practical investment strategies tailored to your unique investment style. Part 5. Building a well-balanced, low-risk portfolio for the defensive investor. As you embark on your investment journey, it's crucial to choose a strategy that aligns with your individual temperament and goals. Will you be a defensive investor or an enterprising investor? Let's explore what it means to be a defensive investor. A defensive investor shies away from risk. Safety is their top priority, which they ensure through investment diversification. Initially, you should distribute your investments between high-grade bonds, like Pull-A government debt securities, and common stocks, where your ownership stakes translate into voting power for significant business decisions. A 50-50 split is ideal, but extremely risk-averse investors could opt for a 75% bonds and 25% stocks arrangement. Stocks and bonds each offer varying degrees of safety and profitability. Bonds offer more security, but yield lesser profits, while stocks carry more risk, but potential for bigger returns. This diversification addresses both inclinations. Further, diversify your common stock portfolio as well. Place your bets on large, renowned companies with a proven track record of success. Spread your investments across a minimum of 10 different companies to lower the risk. Although this diversification might seem like a lot of work, you can streamline the process through the principle of simplicity of choice. In choosing common stocks, there's no need to reinvent the wheel. Review the portfolios of well-established investment funds and model your portfolio after theirs. This doesn't imply blindly hopping on the trendy stock bandwagon. Instead, identify investment funds that have consistently performed well over the years and emulate their strategy. Lastly, don't hesitate to engage the expertise of a professional. They understand the game better and can guide you to make sound investment decisions. If you adhere to these basic principles, your careful prudence will eventually pay off with favorable outcomes. Part 6. Embrace the simplicity of the formula investing approach. Once you've pinpointed the companies to invest in, give yourself a pat on the back. The lion's share of the work is done. All that remains is deciding how much to invest regularly and periodically checking up on your stocks. At this stage, you'll employ the method known as formula investing. This approach strictly adheres to a preset formula dictating how much and how often you invest. It's also known as dollar cost averaging. Here, you consistently invest the same amount of money in a common stock every month or quarter. After selecting a sound and secure stock, it's time to put your investments on cruise control. Decide on a specific amount, say $50, which you'll invest every few months. Then purchase as many stocks as your $50 can buy. The beauty of this strategy lies in its effortlessness. You won't risk overinvesting or resorting to reckless gambling. However, formula investing can be emotionally taxing. Even if your target stock is a steal and you want to buy more, you're constrained by your self-imposed spending limit. Nonetheless, defensive investors should periodically review their investment portfolios to ensure they're performing optimally. A practical rule of thumb is to reassess the distribution of common stocks and bonds in your portfolio every 6 months. Ask yourself, are my stocks still yielding profits? Is the ratio still roughly the same as when I initially invested, for instance, 50-50? Lastly, schedule an annual consultation with a professional to discuss potential adjustments to your portfolio. Equipped with this knowledge, you're poised to embark on your journey as a defensive investor. In the sections to follow, we'll outline the strategies required to thrive as an enterprising investor. Part 7. Enterprising investors can learn from the defensive playbook. To flourish as an enterprising investor, you'll want to incorporate some strategies employed by defensive investors. Like a defensive investor, you'll distribute your resources between bonds and common stocks. While defensive investors typically lean towards a 50-50 stocks and bonds split, enterprising investors lean more towards common stocks due to their higher profitability, despite the increased risk. And similar to defensive investors, enterprising ones should also engage a financial planner. However, the enterprising investor views their financial planner as a partner in money management, not as a guide. Rather than being led by the planner, they make collaborative decisions. Apart from using bonds and common stocks as the foundation for their portfolios, enterprising investors also dabble in other types of stocks that carry higher risk and reward. Suppose you come across a budding startup that you believe could be the next big thing, like Google, for instance. As an enterprising investor, you have the option to gamble on this company, but with a limited amount of money. No matter how enticing an investment opportunity may appear, enterprising investors must cap these stocks at a maximum of 10% of their entire portfolio. Let's face it, even the most intelligent investors aren't infallible, and Mr. Market's volatility can sometimes defy rational prediction. Therefore, we must impose boundaries to safeguard our money in the event of an economic downturn or a poor investment. Just like defensive investors, enterprising investors must remember that regular research and portfolio monitoring are vital to sustain a consistent inflow of profits. Part 8. Enterprising investors shouldn't ride the market wave. When the prices of your stocks plummet, do you immediately offload them or hold on? When another stock's price skyrockets, should you scramble to jump on the bandwagon before it's too late? This reactive strategy, known as market trading, is often employed by investors who fear that swimming against the tide will lead to monetary losses. But a savvy investor knows better. Putting your faith in Mr. Market is a perilous game. If a stock's prices are surging rapidly, it's probably either overpriced relative to its intrinsic value, or it poses a risky investment. Remember the U.S. housing bubble just a few years ago? People continued to pump money into housing as prices spiraled, oblivious to the fact that the prices were way out of sync with their intrinsic value. When this discrepancy became too glaring to overlook, the entire market took a nosedive. To steer clear of such pitfalls, enterprising investors buy stocks in low markets and sell in high ones. Regularly review your portfolio and scrutinize the companies you're invested in. Probe questions like, is the management still effective? How's their financial health? The moment you notice that a company in your portfolio is overrated and its stock prices are inflating with no correlation to its actual worth, it's wiser to sell before it plummets. Conversely, aim to buy stocks in low markets. This is precisely what Yahoo Inc. did in 2002 when it scooped up Inktomi Corp. At a bargain price of $1.65 per share. It was an absolute steal. Mr. Market had grown despondent after Inktomi's shares collapsed from a grossly overvalued $231.625 per share during a time when the company wasn't turning a profit. Part 9. The enterprising investor's treasure hunt for genuine deals. The prospect of becoming an enterprising investor should evoke a sense of exhilarating challenge by now. But is the constant surveillance of your portfolio truly worthwhile? Indeed it is, because that's where the most lucrative deals are, provided you get off on the right foot. The optimal launchpad for your journey as an enterprising investor is virtual stock tracking and selection. Dedicate a year to virtual investing to refine your bargain hunting prowess and track the evolution of your stocks. Nowadays, a myriad of websites offer virtual investment opportunities. All you need to do is sign up and test your mettle at securing better than average results. This one-year trial serves multiple purposes. It not only familiarizes you with the intricacies of investment, but also liberates you from lofty expectations. Once your year-long virtual immersion is over, you're primed for bargain hunting. The best bargains are often found in the stocks of undervalued companies. The market tends to undervalue the stocks of companies that are either momentarily out of favor or grappling with financial losses. For instance, let's say Enterprise B is a major player in the refrigerator market, holding the second rank. The company has demonstrated solid, albeit unspectacular, profits over the past 7 years. However, a production error has dampened its profitability over the recent 2 months, causing its share price to nosedive as jittery investors panic. Once the production mishap is rectified, the company will bounce back to its previous standing. A shrewd investor would view the dropping prices as a golden opportunity to score a fantastic deal. But unearthing bargains is no easy task. That's why it's crucial to gain a year's worth of practice first. If you can thrive in the virtual realm, you can thrive in the real world too. Final summary. The central takeaway from this book: regardless of your investment style, be it conservative or enterprising, the key is to adopt the approach of an intelligent investor when dealing with stocks. By adhering to the principles highlighted here, you can transform your investments into consistent, albeit moderate, gains. Thank you for joining me today on this journey of learning and discovery as we explored the insights of another thought-provoking book in our growing library of knowledge. If you've enjoyed our time together, please take a moment to follow our podcast, give us a 5-star rating, and share 20-minute books with other knowledge seekers. Your support truly means a lot. Don't forget to join me again in the next episode, where we will delve into another enriching book. Until then, happy reading and happy listening.